Welcome back. You're watching us here on Trading. The Nifty Bank is doing extremely well, as a result of which the Nifty has recovered from the lows. We're getting some news from Bloomberg saying that ADIA is likely to buy some stake in Lenskart at a valuation of nearly $4 billion. Interesting one from a startup standpoint. We will monitor its ramifications on the listed space. The only direct competitor to Lenskart in the listed space is Titan, so we'll watch out for how that plans out. But again, it's just a very small component of Titan's overall business. We're talking about markets. Unmesh Sharma, who's the head of institutional equities at HDFC Securities, now joins in to discuss the way forward. Unmesh, how do you feel about the markets right now? We've been seeing them move around in a range. What are the sectors that you're backing?
Okay. No, thanks. So, look, no change in view really from our side. We've had a broadly cautious kind of stance since last August. As the market continues to look for some kind of Fed pivot, you keep getting these spots where there is hope that it's going to happen, and then, these keep getting disappointed. And the net effect really has been that the view as far as the terminal rate of interest is concerned, both in the US as well as in India, has only gone up, right? And the inflation concerns continue to persist. Now, you put that into context, emerging market basket in general would see some kind of pressure because of the risk of in this environment. And on top of that, India has never not been cheap through this. So we are seeing the impact of that. I think, our view remains unchanged at this point in time. That we are likely to keep moving in some kind of small band where you'll get spurts of good news and bad news, and really the market continues to prefer within that. Now, how do you play this, right? So if you look at sectors, we've been sticking with the same views. Okay, we stay with the large banks. If you look at what happened in Q3, all the upgrades have been driven by the financials as well as by the IT sector. So we have some selective positions in IT. Banks, and if you look at our model portfolio, I think for the last 2 years, we have been economy facing and value. It continues to remain like this. So if you look at some of our top topics there, industrials, real estate, we have some power names in there, some autos, pharma, and the long-term thematics like gas and financial inclusion, which is basically capital markets and insurance. So yeah, we stick to that. We stick to that view, yeah.
I was just looking at capital goods infrastructure where you are overweight, and apart from L&T, you also have a holding in names like a KNR Construction, NCC, Cummins. These are some of the mid caps in the space that you like. Now, the target price for most of these companies is just about 10%, upwards of where the stock currently is. I think for Cummins, it's about 1,818, and the current market price is 1,674. For NCC, your target price is 1,100 versus the current market price of 100 rupees. Based on what you are seeing, do you think that, once the market, these stocks go up another 10-odd%, you would exit, or do you think there is a case for you to continue rolling over your positions, your overweight stance?
Okay, so put that into context of where we see the markets headed, right? So I think at the start of this year on this channel, I was saying that we are likely to see single-digit kind of correction in markets, which kind of playing out. Now, in that context, 10%, 12% kind of upside is not that bad. Also, what we believe will happen is that the market will get more and more concentrated because the companies which will deliver earnings, the market will naturally gravitate. I'll give you an example. If you see what happened in the last 6 quarters, the number of stocks in our coverage universe, which is more than 225 now, which beat estimates 6 quarters ago was around 60%. Is fallen to slightly below 40%. So what we expect is that money will shift towards companies which deliver earnings and earnings beats. So from that perspective, in a context where we are seeing markets actually deliver some negative kind of returns, 10% is actually quite good in our view. Now, what do we do if there is a rally of 10%? Well, we'll have to see. There's no way for me to know what will drive it there. What we believe is that as companies deliver earnings, and as we walk into the second half of the year, maybe post the June quarter, as the market starts to look at FY25, because right now I think all the stocks are being looked at on an FY24 basis, we will see where the earnings upgrades and downgrades come through. We generally have a very low churn on our model portfolio, but we'll obviously revisit all of this as we start to go into that kind of time frame.
All right, and Unmesh, is there any change in what you think about for IT services as well? And take us through what you think of some of the large cap as well as the mid cap names. I do see that there are perhaps more positives amongst the mid caps from the list that we do have from your report. But take us through what you think of this entire space.
So IT, we are quite selective. While if you look at our model portfolio, is actually slightly underweight. But to a large extent, that is because of our some valuation discomfort that we have on one large name, which is TCS, and that's a slight underweight, even though it's a large position given the context of where it is. So if you look at it from that perspective, bottom up, we like Infosys and HCL amongst the larger ones, and Tech Mahindra Cyient are the two which we have there, and MCX. So what we do is that we also look at the tech-oriented, not just technology services type of companies in there. So IT and exchanges is really how we think about it. So we have an off the portfolio, of the index kind of view, alpha position, so as to speak, on MCX. So that's how we are looking at it. Basically, it's really bottom up. It's tough to find value in the market in general, to be honest, given how much macro uncertainty there is. So if you look across sectors, not just in IT, you will find that we've tried to find pockets where we have very high confidence, good visibility on FY24, and possibility that as we move through this year, and hopefully, we have a little bit more clarity on the macro, we will be able to identify companies where there is clear visibility of growth on earnings.
Right, still quite selective on IT, but you do like the bank space, also overweight pharma that we can see in your portfolio, and a lot of the power plays. But we are going to leave it at that. Unmesh, thanks a lot as always for joining us and taking out the time. We do need to get into a short break now, but as we do that, here's a quick programming note. On the 14th of March, CNBC-TV18 will host what will be India's largest summit on gender parity in Delhi. So women leaders from all walks of life will come together to brainstorm and help take decisive steps to bridge the gender inequality that exists in India and across the world. The event starts at 4:30 p.m. on the 14th of March, and you can catch all the live action right here only on CNBC-TV18.